terms of raising finance, very comprehensive methods of finance as well. So if we can please give Paulo, your first speaker, a round of applause.
Thank you, thank you. Can everyone hear me okay? Yeah? At the back? Yeah? Good. Okay, so we're going to cover debt versus equity. Okay? So the sources of funding, financing for startups, early stage, small companies. Okay, so we're going to be covering that. Can I just ask from everyone here, has anyone already a company? Is anyone trading already? No. Anyone starting a company? You're starting a company, you're starting a company, starting a company, starting a company? Okay, so we're going to try and cover some of the aspects, the critical aspects about how to fund your company, how to get money in, okay, how to bring investors in, and just a little about me. I've been in the city since 1999. I run a corporate finance boutique advisory company, and I'd like to thank Ian Campaigns and Theodore for extending the invitation to come in. So what we're going to be doing is, this is going to cover about 25 minutes. We're going to be covering an overview, debt versus equity. Why is this important? Why is this so important? Then definitions, what is equity, what is debt, how does it interact with your business, how much does it cost, okay, how much do you have to pay every year, every month to have equity, to have debt in your company, to have investors in. Then where to find investors, where to find equity, okay, where to find debt, who gives out debt, who gives out equity loans. A couple of tips for startups, right? That's going to be the focus of this presentation today. Startups, early stage, seed capital, startup capital, and then we're going to just do a bit more technical on how to use debt and equity how to make money, basically, on debt and equity funding. How do you make money as a shareholder, as a founder of a company? Okay. So, overview. Where's the equity? Pension funds have about 44 trillion pounds in equity. Okay, that's trillion with a T, not with a B. It's not a million, it's not a billion, it's a trillion. Private equity funds have about 1.3 trillion. And then the smallest category of all is venture capital. Venture capital, crowdfunding. We're going to be talking a lot about crowdfunding for small businesses. So that's where the money is. Why is this so important? Okay, in a nutshell, if you get this right, if you get the balance of debt and equity in your company, which is called a capital structure, if you get this right, you will have a much stronger company, you will have less problems, you'll have a balanced company, okay? It's going to be easier for you to raise funds when you need them, both equity and debt. So, ultimately you're going to survive long term, which is a big problem for startups. They usually fall within 2 to 3 years, according to international statistics. So if you get, and they usually fall because of the debt and equity imbalance. Okay. If you get this wrong, you will have loads of problems. You will have inability to raise funds. You will have lack of money to progress, to fund your company, to move forward, and ultimately you can go under if things really go bad. You can go under, and this is one of the main sources of liquidity problems. So what's equity? Okay, we're going to try and maintain this very plain speak. No technicalities unless we need to. Okay, so equity is basically cash. That's money. Equity. Think of equity as money you pay your business, right? So when you start up your own business, you're going to think, okay, where am I going to find the money? It's going to be my money, it's going to be someone else's money. That's going to be paid into the business. You're going to buy equipment, you're going to buy stuff, you're going to buy stock, working capital, you need money to start, you need money for accountants, lawyers, etc., etc. That's the equity. That's where the equity is. That's cash. Okay. It can also be sweat equity. So if any of you has worked in a tech startup, sweat equity is a common way to fund these projects. You get people to work for free, literally, and then they get equity in the business. Okay, that's called sweat equity. And it can also be assets. It can be you can, if you have an office, okay, you can lend the office. That's equity. Okay, if someone needs an office and you have the space, that's equity. It may not be cash, but that's an asset for the business. And the big item here with equity is that it's the base of market economy. Okay, the Soviet Union tried to bypass equity. They failed. Okay, so it's the base of market economy. It's the base of everything that we do as companies. And the sole objective is to increase value. Okay, so you want to invest 100, take out 200, 300, 400. Okay. What's cost of equity? Okay, equity has a cost. Okay, this is extremely important for everyone to understand. Equity has a cost. That cost is the economic choice of having the money in your company rather than anywhere else. When you invest the money in your company, you could have put the money elsewhere. You could have put the money in UK guilds, where the government guarantees it. You're going to get 100. You're guaranteed to get the money back. It's no risk. You could have got the money in a PEP or an ISA or a mutual fund. Hardly any risk. Okay. You chose to put the money into your company or someone else's company. Okay, so that has a cost, and that has to be paid. And it's quite expensive. Most people, most companies, sometimes they don't understand this, and it's a basic concept. It has a big cost. So if you put in money into your company, even if it's your own company and you're the sole shareholder, you want money back. You want your money back, and you're going to see how to calculate that in a second and how much money you want back. Okay, the main issue with cost of equity, it's invisible, literally. You can't see it in an income statement, you can't see it in a balance sheet, you can't see it in a cash flow statement, you can't see it anywhere. You look at any accounting or cash flow statement, any economic statement or accounting-based statement, and it's not there. So a lot of people, they fail to see this because it's invisible. Okay, it's nowhere to be seen, literally. So, how much does equity cost? So, if you start a business today, how much do you want to get paid? So, if you see, this is Snapchat. I don't know if you know the symbol. Snapchat. It's a US tech startup. Okay, they're quite big as a startup. However, they are a startup, so they have hardly any revenue. They're very recently created. I think they're 2 or 3 years old. So they would have a cost of equity of about 30s, mid-30s a year. And you can see, and I'll calculate that in a second. So Tate & Lyle, which is a UK company which is fairly large, the turnover is about 5 billion a year. They would have a cost of equity of about 20% a year-ish. Royal Dutch Shell, the largest UK company in turnover value, in turnover amount, has a cost of equity of about 8% a year. Okay, so about 30, 28. So as you see, what's the criteria here? The bigger it gets, the bigger the company gets, and the more client it has, in a nutshell. That's what counts. So a company with zero revenue, a seed company. So a company which is, you're having an idea, you're starting to think about it, you're starting to build a prototype or write software. That's seed capital. You haven't got the company out, you haven't got the product or the service out. That's seed company, that's seed capital. That has a lot of risk. When you start up, if you start up and the product goes through the market, lowers the risk. I mean, it should be obvious. If you have a company which doesn't have anything, it's not selling anything, or not being able to have any clients, it has a lot of risk. If you go to an investor and say, okay, can you please give me some money for that? So I'll give you some money, but it's going to cost you something. It's going to cost you a lot. So a company like Royal Dutch Shell, which has about 130 billion a year in turnover, you could argue that that company has a lot of clients. So it is much cheaper to lend money to that company or to issue equity to buy shares in that company. Much cheaper. So you're gonna require less money. That's how it goes. So it is quite a common sense principle. Okay, we're gonna try to quantify that, but it's quite common sense. So the bigger it gets and the more clients it has, the less equity, the less cost of equity. So how much money do you want? If you started your company here, year one, how much, after 4 years, how much money do you want in your bank account when you sell it? You started this company with £100,000. So you started with £100,000. In year one, that was seed money, okay? You had zero revenue. You couldn't sell anything. So you built up your business, you built up your products. You got to a stage where you did a startup in year two. So the startup had an impact of, it nearly wiped about 40% of your cost of equity. Okay? When you were here in seeds, you had to pay about 50% a year. Now, this is not like a loan. This is equity. You don't have to pay it every month. You don't have to pay it back. You only pay it. You only pay or you get to return when you sell. That's it. Okay? You're not going to pay this as a loan. This is not a loan. Debt is a loan, and then you pay monthly. This is equity. It has a cost. This is how much you require for your money to be returned every year, okay, as the company develops. So in year three, you've done a successful startup. You sold 1 million. Okay, that's by any standards, that's a good startup. So you're off the hook. You've done the market test. You've sold 1 million. Your cost of equity dropped to 25% a year. And in year four, okay, you really had it going for you this year. You sold 10 million, and the 10 million did the asset test for your company. It proved that you've got a successful business plan. You're a well-managed company. Your cost of equity dropped to 20%. So after 4 years, your initial and only investment was 100,000. That's all you put in. The 100,000 transformed into about 300 in 4 years. Okay, so that's how much money you want to be required to be paid. You want to transform your initial £100 into £300 in less than 4 years. This is a typical example. Not many companies can do this. Some do it quicker. Most do it a lot slower, I guess. It's just an example. If you had this going slower, this would accumulate every year. It's like when you go in a taxi. But the minute you go in a taxi, you walk in a taxi. That's a meter. You know, so as you have your own company, this is counted. This is a meter, which is counted. Cost of equity. This is very important for everyone which is starting your company to understand. Because if you don't understand this, when you reach here or here or here and you need more money, people will ask you for this. How much have you returned in the last year, 2 years, 3 years? They'll ask you for that. Okay? So how much do typical SMEs owe shareholders? A typical SME